All right, welcome back to Intermediate Accounting Chapter 6. We're talking about revenue recognition. This is the second video, so make sure if you haven't watched the first video, you do that because it will definitely help in understanding the first things to consider when it comes to revenue recognition. So in this video, we are going to get into things that are a little more complicated, special issues in revenue recognition. So we have the 5 steps, but here we've got 5 steps with special issues to consider. So we know step 1, specific requirements for contract existence. Step 2, the prepayments. There could be warranties, customer options for additional goods or services. So some things that we could consider in special situations. Step 3, consider variable consideration, significant financing components, non-cash consideration, and consideration payable to customer. Step 4, use relative standalone selling prices and apply appropriate discounts or variable amounts if they apply only to certain obligations. And then step 5, we have to decide if revenue should be recognized over time or a point in time, and assess the license, consignment, or bill and hold arrangements if relevant. So we're going to break all this down. That's a lot of words. I like to read it just because I can't stand when somebody is like presenting and they don't ever say what it is. They don't ever read the slide. And I'm like, I'm trying to read it and listen. But don't worry, we're going to break out each of these in great detail. So step 1, identify the contract. So contracts can be explicit or implicit. They can be oral or written. So a contract only exists if it has commercial substance, which means it has like a material impact on the financial statements or a cash flow. It actually is going to be an amount worth recognizing. It has been approved by the seller and the customer, super important. Specifies the rights of the seller and customer, specifies the payment terms. Again, this can be oral or written. It doesn't have to be all written out. And it's probable that the seller will collect the amount it's entitled to receive under the contract. So all of those are important in order to have a contract with a seller and a buyer. It does not exist, however, if neither the seller nor the customer has performed any obligations under the contract. So remember in the Sunset Sound Systems example we did first, where they had an agreement to deliver equipment for a concert, but they hadn't done anything yet. Well, whenever they had the agreement, it didn't meet that first criteria there. So the seller nor the customer has performed any obligations under the contract, and both the seller and the customer can terminate the contract without penalty. So if they have a contract, neither one of them have performed anything, but the contract says that they have to, meet a certain, or they cannot just back out, or there's going to be a penalty, then the contract does exist. So let's look back at our Sunset Sound Systems. I saw the most beautiful sunset this morning, you guys. I am in Las Vegas for a work conference, and my view is absolutely unbelievable. Maybe I'll pop the picture up there for you, but from my room, got to watch the sunrise over the mountains. So this is the perfect name for a company, besides how challenging it is to say. So Sunset Sound System sells a bundled package called the Sunset Starter Kit for $1,500. That package includes the studio subscription and the equipment. So Easy Buy Electronics ordered 500 Sunset Starter Kits from Sunset on June 30th, 2025. Easy Buy pays the full $750,000 upfront on August 1st. The equipment is delivered immediately, and the subscription begins August 1st and provides service evenly over 12 months. So a lot to consider here. They make the agreement, or they order the kits on June 30th, but it's not until August 1st that payment is delivered and then the equipment is delivered and they can start using the subscription services. So when does Sunset's arrangement qualify as a contract under the revenue recognition criteria? So we have to think about the revenue recognition criteria. and that would be August 1st, because nothing has happened between the two, the seller and the customer, until August 1st. So that's how we determine that in this situation. Step 2, identify performance obligations. So it is not performance obligations if there's prepayments or a portion of the transaction price. That does not mean there's separate performance obligations. The quality assurance warranty guarantee that a product meets stated standards are not separate performance obligations. They are part of the original sale. Right of return lets the customer return products, and it creates a separate performance related to that. So these are things that does not make it two separate performance obligation under these. Now, we will see with an extended warranty that's different, because with an extended warranty, the customer is paying to have a whole separate performance obligation beyond just the quality assurance. Hey, we're selling you a toaster, you should expect it to make toast, right? So let's look at what does count. Oh, I forgot the next slide said extended warranties. I jumped ahead. I must have felt very adamant about what I was going to say. Extended warranties are the warranties that extend even after that warranty that comes with the product. So that was optional for the customer, and it can provide quality assurance beyond what just the regular quality warranty would. Options that provide a material right. Material right is something that a customer would not receive otherwise, so the seller is obligated to provide it. So this is something beyond a separate performance obligation, beyond what they were already required that came with that initial performance obligation. So it's only separate if it's very clear that, like the subscription is very clear that it is separate from the equipment. It's not all just one thing, even if you're able to pay for it in a bundle. So let's jump back to Sunset Sound Systems. They sell a speaker system for the $500, and the customer receives a 20% off coupon for future purchases. The coupon is expected to be redeemed and provides a material right, making a separate performance obligation. So, you ever bought something before and you do get a coupon to go along with it because they want you to come back and buy more? Well, that's what's happening here. So, they sell the $500 speaker, they give a 20% coupon. The standalone prices, the speaker would normally be $480. Now, hopefully, you're not shocked by this. A lot of times, whenever you get some kind of incentive to go with the product, you're like, whoa, look at this. I get this coupon to go along with this. But they typically would have sold the system for $480. They actually upcharged it to cover some of the discount they're giving you. The 20% off is valued at $120. So you're still basically getting a $100 discount, right? But if you think about it with a business sense, they might be giving you $100 if you use a coupon, but a lot of people won't, and they're getting $20 from each person. So it's not foolish business practices at all. So allocate the transaction price, the $500, between the speaker and the coupon. We've already looked at how we allocate that, but we'll do it again here. And then how much revenue should Sunset Sound Systems recognize at the time of the sale? So let's look at this. Step 1, we got to find the total standalone prices. We already know it's $480 for the speaker, $120 for the coupon. So that's total of $600. So if we break that out, 480 divided by the total 600 means 80% of that standalone price is, or 80% of that total price would be for the speaker, and then 20% would be for the coupon. Well, they didn't charge them $600, they only charged them $500. So we're going to take the $500 times the percentages, and that breaks out how much we want to allocate to each one. This is the same thing we did previously in this chapter. So the $500 times the 80% shows that we're going to put $400 towards the speaker when we recognize this, and then the $500 times the 20% says we're going to put $100 towards deferred revenue that we may get from the coupon. So here's how we record it. We don't show cash coming in for $600 because they did not pay us $600, even though that's how much the standalone prices would have totaled to be. We show cash of the $500. Cash should be really simple. We got $500 in cash. Then we're going to show the sales revenue for the speakers. We provided the speakers for them already. That performance obligation is complete. Then we show the contract liability for the coupon of the $100. So we haven't given them anything for this, but since we gave them a discount, we're going to go ahead and show that separate performance obligation as a liability because it's deferred until they choose to use it another time. You can imagine how challenging the accounting is for these companies that offer, like, I think like Old Navy, Kohl's. They're like, if you buy enough, then you'll get a coupon so that you can come back and have, like basically Kohl's bucks or Old Navy money. You can come back later and get a discount like in 2 weeks. So you can imagine they would have to do all of this here. So now we need to determine the transaction price. So estimating the transaction price involves a variety of consideration, including variable consideration, the right of return that the customer may have, if there's a principal or agent, the time value of money, and payments by the seller to the customer. A lot of stuff to consider under step 3 for special issues. We're going to look at some of those in the rest of this video, but we're not going to look at all of it yet. So let's start with variable consideration. And that's where a portion of transaction price depends on the outcome of future events. So it could be something like construction, there's some incentive payments there. Entertainment and media, there's a lot of royalties with that. Healthcare, there could be reimbursements through that. Manufacturing, there can be discounts and returns. Telecommunications, there's a lot of rebates. So these are all things that are determined later on. So when this happens, we need to go ahead and record some revenue when we actually perform our part, even though there's some variable consideration down the line. So there's 2 different methods that we're going to look at using, and that's what we'll finish this video with. So we have the expected value method and then the most likely method. So they select a method based on the ability to predict the best amount that the seller will receive. So let's look at an example and we'll finish up this video with these. So we got the same company. They enter into a contract to sell a sound equipment to concert venue for $10,000. The contract includes performance bonus of $2,000 if the equipment is delivered and fully installed by the set deadline. Sunset estimates that 75% probability that they'll meet the deadline. Whoop, went too far. Expected value method is what we're going to do first. So with this, we think that there is a 75% chance they'll get that $2,000 bonus. So our expected bonus, $2,000 times the 75%, we're going to use the product of that, the $1,500. We add that to the $10,000, and that gives us $11,500 is our expected revenue. So we're taking that 75% into consideration. So if the deadline is met, that's what we're considering is going to happen. We show accounts receivable for the $11,500, and we go ahead and show sales revenue for that under the expected value method. I don't love this method. You may feel the same way where it's like, but I'm either going to get 0 or 2,000 for this bonus, not 1,500. So it's like they're trying to be a little bit conservative and not show the whole 2,000, but they're still showing most of it, and it's just a little bit odd, right? But this is a method that companies are allowed to use, whether you love it or not. So we've got the same situation, but if we use the most likely amount method, because meeting the deadline is most likely outcome, 75% chance they're going to meet the deadline, Sunset includes the full $2,000 bonus. I personally like this one better, especially in this situation, because it's like, again, you're either going to get none of the bonus or all of the bonus. So let's recognize all of it or none of it. So here they're like 75% chance. We're being conservative, but we're very likely to meet that. So we'll go ahead and record the full $10,000 revenue for the equipment plus the $2,000 bonus, because that is most likely to happen. It's a 75% chance. So we show accounts receivable for $10,000, missing a 0 there, and bonus receivable for $2,000. So total sales revenue for $12,000. So same thing here, but if the equipment is not delivered and fully installed by the set deadline, we're going to have to reverse out that $2,000 if we use the most likely method. So we're going to take sales revenue and debit it. We're taking it out of sales revenue for $2,000, and then we credit the bonus receivable. So if we had used the most likely method and we had already recorded the bonus as if we were going to earn it, and then we don't, we just reverse that portion of the entry. Sellers only include an estimated variable consideration in the transaction price to the extent that is probable that a significant revenue reversal will not occur. So in other words, if they think that it may reverse after that, then they're not gonna record it. So again, it's kind of going to the most likely situation. So indicators of that could be poor evidence on which to base an estimate. So maybe they say 75%, but they really don't have a very good way to estimate it, so they're not feeling too good about it. It could be dependence of the estimate on factors outside of the seller's control. So as much as we want to meet that deadline, there's some things that may affect it. Maybe it's the weather. Maybe we won't be able to install the equipment if the weather's bad. That's out of our control. Maybe we shouldn't record that bonus yet. A history of the seller changing payment terms on similar contracts. Shouldn't record it in that case. A broad range of outcomes that could occur. So there's just too many variable factors, or a long delay before uncertainty resolves. So it may be a long time before we can tell whether or not we meet that. Any of these make us lean towards not recording that variable consideration, that $2,000 bonus. So assume that Sunset concludes that it is probable that a significant revenue reversal will occur in the future, or they at least find that they can't deny that it may happen. In that case, we just record what we know, that $10,000 of equipment. Not sure about the $2,000 bonus. Let's just record the $10,000. If we get it, great, we can record it later. But in accounting, we want to be conservative, and this is the best way to be conservative if we feel like something may happen to prevent us from getting that $2,000 bonus. All right, more to come on this chapter. We're only about halfway through, not even quite that far. So make sure you stay tuned and watch the rest of the videos.